Hello, this lecture is entitled Ethics, Profession, and Generally Accepted Accounting Principles. Objectives. Objectives will be, we will be able to define profession, define ethics as it relates to accounting, explain the importance of ethics with regard to a profession, define Generally Accepted Accounting Principles, otherwise known as GAAP, define fraud, explain the factors that increase the likelihood of fraud, define internal controls, and explain how internal controls are used. So a lot of these themes are going to relate to trust. So we're going to talk about ideas that relate to trust. Trust is going to be very important because it is a factor in terms of business. If we're going to do business with someone, if we think about things we do business with, areas we do business with, people we do business with, usually one of the factors in that is going to be trust. So it's in a profession's best interest to facilitate trust in the profession. So, two questions. What is a profession? What is trust? So first, a profession. A profession is a vocation that requires some specialized knowledge. So some type of specialized knowledge within the vocation. It takes some time to get that specialized knowledge. For example, in the legal profession, the medical profession. Probably some of us remember our parents saying, we want the kid to grow up to be either a doctor or a lawyer. Those are some of the older professions. And if we think about what makes those a profession, it generally is that they have a specialized knowledge that takes a long period of time in order to gather, and therefore, if we need either a doctor or a lawyer, then we are basically dependent on their decision. So that has to deal with trust. We need to be able to trust their decision because we don't have the time, of course, to put in the amount of time to gain that knowledge in order to verify whether or not what they are telling us is trustworthy. As opposed to if we do business in other areas. If I go to the store and I'm not sure if their produce is fresh all the time, we can at least look at it and verify, or after going there a few times, we can verify that it's not up to standard and we can go somewhere else. But, of course, in the legal profession or a medical profession, we do not have that option. We need to know that the person that is giving us the information is both competent and able to do the information in order to give us the information that is appropriate. They have the skills to do so. And we also need to know that they are ethical in that they are looking out for our best interests and not just their best interests. And that's going to be the ideas of the profession. And it's within the profession's best interest to promote the idea of ethics. We can see both in the legal profession and the medical profession that lapses in ethical problems or the perception of ethics within the profession can harm the profession. For example, in the medical profession, obviously, there are points in time in history where people proclaim to have knowledge and could sell things or make a profit selling things that are not effective in order to make a profit. That not only harms the individual doing that, it harms their reputation, but it harms the reputation of the profession, because then the other next individual coming along saying that they do know what they're talking about, it's more difficult to generate that trust. And once again, in business, it's very difficult to do business without trust. One of the main things that we want to cultivate within the profession, within business itself, is trust. This seems somewhat counterintuitive when we think about a lot of the TV shows and movies that are out there that portray business as the scandal. And we usually see the scandals within business. And there are business scandals out there, of course. But if we think about our day-to-day transactions, we generally transact with people that we trust. We're going to look for people that have the trust. And if we're going to do business, we're going to start a business, then that trust is going to be a big factor that we're going to need to build up. In terms of the profession as a whole has incentive to build up trust, and they could do this by licensing, such as legals and medical have a licensing type of process. The accounting has a licensing process now to become a certified public accountant. Other types of licensings are also in the business sector. Notice that as businesses became more prevalent, as business grew, and as we came up with more tools in order to run the business, such as a corporation, now limited liability corporations, different types of ideas, different types of entities, different types of taxation. Of course, with the growth of regulation, that means that the specialized knowledge has become larger. There's more specialized knowledge. So the accounting profession became more and more necessary and more necessary to have an organization in order to regulate the profession. Now, even within, of course, the accounting profession, we have other types of areas within there, being we could specialize in payroll and have professions basically designed to that. We can be in internal auditor. We can be in managerial accounting. And we're starting to see subsections of professions within professions, once again, because of the amount of specialized knowledge that is needed. So what is ethics and how does it apply? If we just did a Google search on ethics, we would see something, a system of moral principles is one type of definition. The rules of conduct recognized in respect to a particular class of human actions or particular group, culture, etc., medical ethics, Christian ethics. The branch of philosophy dealing with values related to human contact with respect to rightness and wrongness or of certain actions and to goodness and badness of motives. So we can see there's a lot of definitions of ethics. Ethics, of course, is something that's been talked about for a long time. In Western culture, if you start thinking about ethics, they were talking about ethics since, Plato and Aristotle had theories on ethics. We're going to try to, of course, narrow it down and apply it to an ethical type of idea to the field of accounting. Ethics, when we talk about the ethics, the basic questions often come up is whether or not there are a universal set ethics out there that are really applied and they're part of nature, and we just need to find those ethics and define what those moral principles are because they're solid and real. Or there's, of course, an idea that ethics change over time and ethics are different in terms of where you are in time and where you are in a certain group. And we're not going to have to address that or answer that here. What I do think is applicable in terms of ethics with regard to the profession is that ethics is both could be considered correct thing to do. It's also the correct thing to do within the profession. The reason it's the correct thing to do in the profession is, one, it could just be a moral principle, correct thing to do, but also it's in the businesses, it's in the profession's best interest to act in these types of moral ways. So we're going to set up a set of principles that will be ethical in terms of both the right thing to do for moral principles in terms of making the financial statements look and be correct, as well as what is correct for the business as a whole, or in the profession as a whole. The profession benefits from a strong set of ethics because ethics builds trust, and trust is good for the profession. So if one individual in the profession is profiting by the name of the profession, basically the brand, say we had a certified public accountant that was doing things that are unethical in terms of the code of conduct of the profession, then it would be in the profession's best interest to remove that individual because they're profiting off of hurting the name of the profession. So in that sense, the profession benefits from a code of conduct, and we need to have that out there. A lot of the investments within the United States, we generate a lot of investments into our stocks, our companies from outside the United States. And it's not solely because we are lined up for the most growth, because actually countries that are less developed are more likely to grow than we are at a faster rate. But we do draw a lot in a large degree because people trust the financials that we put out there. We spend a lot of time and money putting regulations in so that we standardize financial statements. And in so doing, people can look at those financials and say, I think this actually reflects what is out there, and therefore they're more likely to invest in the companies. Generally accepted accounting principles, otherwise known as GAAP. So generally accepted accounting principles, the Securities and Exchange Commission has the authority to implement the regulations. They basically give that authority to the Financial Accounting Standards Board, or the SEC to the FASB, And the FASB then basically makes the generally accepted accounting principles, which is, for the most part, a set of rules and regulations that publicly traded companies are basically required to follow, because publicly traded companies are trading to the public. And so the idea being that if we are trading to the public, then the public needs to trust the financial statements. Therefore, there needs to be some standardization to the financial statements. Therefore, they need to be regulated. There's going to be less regulation when we talk about non-publicly traded financial statements, because they don't have as much responsibility to disclose everything to the public, because they're not asking the public to trade their stocks. They're not publicly trading their stocks. Now, the rules within ethics are going, and within the generally accepted accounting principles, are going to include some of our basic accounting principles, such as the double entry accounting system. They're going to basically include a lot of the best practices, accrual accounting practices for the most part. And I want to point out that those concepts, the accrual concepts, did not come about because of regulation. The accrual concepts are generally best practices. They came about because people wanted to get relevant information, and they came up with best practices to do that, including accrual accounting and double entry accounting systems. The generally accepted accounting principles are an attempt to standardize these systems, so they're generally going to take the best practices, but then standardize them, make sure that we are generally generating financial statements that are in conformity, so that investors can compare one period to another period and know what they're looking at. They can compare one company to another company and know what they're looking at. They're comparing apples to apples. So the goal of generally accepted accounting principles, the goal of the financial statements as a whole, is generally for external users, meaning investors or creditors. And what we're trying to do is create conformity in that. Once again, that will create trust in the financial statements that they're reporting correctly, and that will lead to easier business to be conducted. Fraud. So we're going to talk about fraud. Now, the definition of fraud has to do with intention. So it would be an intention, a purposeful intention to deceive, usually for personal benefit. So if we either stole something for personal benefit and or we falsified financial statements for personal benefit, then that would be fraud. The key, again, being intent. If there was no intent, then someone could still be liable for negligence, but the intent is usually what makes something fraud. Now, this is seen in a lot of areas of law, this idea of intent, meaning making the crime more than it otherwise would be. And we can see that, for example, if there was a car accident and someone hit someone else, ran someone over, then there would be much difference in what we perceive to be how bad the crime was, and the punishments being reflected would differ if the person who ran the other individual over actually intended to do that, which would be murder, as opposed to if it was accidental, which means it might be manslaughter. And the result's the same. The person got ran over, but we see the intent as a crucial factor in terms of how bad the crime was. So the same idea is in terms of fraud. The intention is what makes it worse. And there's two areas where fraud could happen. It could happen on the employee side, stealing. It could happen on the management side. The employee, if we catch the employee committing fraud, we can let the employee go, we can fire the employee, and it's not as big a deal. If the fraud is on the management side, then we have a bigger problem, because they can circumvent controls, and if there's unethical behavior on the management side, it's very likely that that type of thought and mentality will become the culture of the organization, and that it will be bad for the culture and lead to bad environment. It's often thought that fraud is just the fault of the person who committed the fraud. So it's all their fault, and they do have responsibility no matter what the circumstances generally were. If someone did something that we believe is wrong, then of course they did something that's wrong. They need to, be held accountable for that. But that we also know that there is environments that would be more subject to fraud happening, and we as companies could change the environment in order to lessen the likelihood of fraud. For example, if there's an opportunity out there, such as, let's say that a company decided to keep their petty cash fund in the middle table in the lunchroom every day, all day long, it's more likely that the opportunity would then be there that someone might say, whoa, I can take that and not be caught for that. And on top of that, if there's financial pressure, if we know that a lot of the employees are under financial pressure in their homes, then that could lead to a heightened risk of fraud. And then, of course, there's rationalization. So if someone commits fraud, they're often going to justify their actions. They're never going to say that I was wrong. That's not how we generally think. We generally think that, the circumstances were wrong. The circumstances were the things that led to that's going to be the rationalization. So, for example, if someone took the money from the lunchroom, then the rationalization could be something like, well, if the company is so irresponsible as to put the money in the middle of the lunchroom all day long, then, they deserve to lose it or something like that. Again, that's not right. It's still wrong to take someone else's money or something that doesn't belong there, but you can see how that rationalization can happen. As a company gets larger, it could be a lot easier to rationalize as well. So, a large company, a lot of people will say, well, this is a large company. They have a lot of money. They don't need it. I do need it. And therefore, it's like taken from the rich and given to the poor, being myself. That could be a type of rationalization. We also see that if something happens one time, then the likelihood of it happening again is increased. So, fraud tends to escalate or at least continue over time. So, our question then, of course, on the company side is there a way that we can, lessen the circumstances and therefore lessen the likelihood of fraud? And a lot of that would be in terms of internal controls. So we could try to set up internal controls. Obviously, one big internal control would be to not put the money in the middle of the lunchroom. We could try to put it in a lockbox or something. That would be a logical internal control. And we could also, one of the major things I want you to think about when we think of internal controls is separation of duties. And that, for small companies, we cannot do that as much because we may have a small accounting department. But if we have a large company, then the larger the accounting department, we could separate what people do. And by doing that, then it would take more than one person to commit fraud. For example, if we have a difference between the individual that is handling the money and the individual that is recording the money, then in order to take the money without it being seen, the two individuals would have to collude or get together and make that transaction happen. That would be one of the major things later on that we're going to talk about in terms of internal control, is the separation of duties. Now, note that could make things more difficult, make things longer a process. If I have to, go to someone else to complete a transaction or get approval from someone, that's like red tape. And that slows down the process in some ways, but it also safeguards against fraud. So we need to find that balance somewhere between a relevant number of safeguards, a relevant amount of red tape that slows us down a bit, but that safeguards us against internal control type problems, against fraud, against reporting things that are not correct. So now we are now able to define profession, define ethics as it relates to accounting, explain the importance of ethics with regard to profession, define generally accepted accounting principles, otherwise known as GAAP, define fraud, explain the factors that increase the likelihood of fraud, and define internal controls. Explain how internal controls are used.